Okay, so this is the weekly Tortoise report review for May 26, 2012. It's our Memorial Day edition. We'll start off here with a review of the weekend report. We're in bullish volatile conditions, and we have been all week. We're at 49 out of 100 on weekly RSI 14, so right in the middle. We're at 42 out of 100 on the 10-day NDX, so trade location there is also neutral. Percent stretch above the 200-day moving average is 3.49%. You'll recall last week we were at 2.06. We were right on the boundary of sideways, and we're able to whistle past that graveyard and put in some gains for this week, but we're still very close. We're within a weekly ATR percentage of going into sideways volatile. So by no means are we out of the woods yet. I still think that the news is looking mostly at Europe and Greece shenanigans, and so the U.S. looks good by comparison, and that's the only thing that's holding us up right now. John Malden had an interesting guest essayist who was comparing, the plight of California with that of Greece, and I found that to be pretty interesting reading. So for the moment, based on price relative to 200, we are still in bullish conditions. Slope of the 50-day moving average is still red bearish at minus 0.51%, and that's getting worse. ADX 14 is almost at 30, which makes it a very strong bearish intermediate trend. And you'll recall anything over 30 is extremely strong for the market. ATR percentage at 1.39 puts it into volatile conditions. The 26 ETF portfolio still in the holdings this month were the Qs, financials, and U.S. real estate. And the 13 ETF portfolio with the Qs, U.S. real estate, and U.S. large caps, and that's due to be rebalanced next week. That will probably result in cash positions based on the current read, unless there's some kind of extraordinary moves. I would expect that to be all cash. ETF2, the theoretical exposure is at 0%. The model portfolio remains at 60%. Moving on. Next, just a quick look at the portfolios for blended monthly. You can see that U.S. real estate remains at the top, the only thing in the green, followed by treasuries, the NASDAQ, technology, mid-caps, diamonds, and small caps. So it's all U.S. and then the rest of the world. And then the alternate investments in the U.S., real estate and treasuries, are leading the way, with only real estate and treasuries showing positive. So I take that back. I guess I expect those two to be in the portfolio for next month. Looking at the 26 ETF portfolio. Again, it's really the same lineup, all U.S., and then we're adding in financials, emerging market bonds, short-term bonds. Swiss franc has moved off the bottom and pushed its way back into the top half. But with only 3 on buy signals: real estate treasuries and short-term treasuries. So I guess that's going to dominate next month. Next up is the market health check. So the vertical blue lines are 10, 20, and 30 days worth of look-back period. The horizontal purple lines at 142, 136, and 134 represent important support levels that have held before, but which are now acting as resistance levels or price targets in this case. The horizontal red line at 130 right now is the last firewall we have between this and a return to the bear market. We would get into sideways conditions at 2% above the 200-day moving average, which would be right about just under 130. So that red line is almost the boundary between bullish and sideways conditions, and it's had one test already. And this week, although it turned in some positive gains, most of that was just off the first day's bounce, Monday's bounce up, and then the rest of it has been not very convincing, as it has not really even been able to get to 134. It kind of hit the 10-day moving average and held, and it's starting to roll over a little bit. You see the black line in the middle is the 30-period regression line lagging 1 day. The black lines are the outer black lines are the regression channel formed by the maximum excursion from that line during the look-back period, which happened up in May, early in May. The blue shaded area is the river formed by the 30-period Bollinger Band with one plus or minus one standard deviation. The dotted line in the middle, a little hard to see, is the 30-period simple moving average. And so that represents the normal price action. You can see how that's rolled over and is expanding to the downside. That's an intermediate term rollover, and then with increasing volatility based on the Bollinger Band getting wider. The blue channel is an Andrews pitchfork, which extends the Bollinger Band channel forward, or the regression line channel forward, excuse me, and that gives us a projection of where price would go as long as the underlying factors in the market don't materially change. It would take a close either above 136 or below, looks like about 128, to signal either a strengthening market or a weakening market. But if it keeps up with its current trend, then we would expect price to remain inside these three blue lines, that bluish channel. You can see the 5% sell-off from the swing high at 142 comes in right about 135, where there is a pile of resistance. And then a 10% sell-off, which would be the end of a correction and the start of a bear market, comes in at about 120. Looks like about 127. It's about 128, I think. You see the Williams percent R10 was in oversold conditions, has squeaked into the low neutral, but it's not a convincing move up right now. The percent price oscillator rolled over in early May to warn us about the end of the end of the bullish move, and the jaws just came together and closed, signaling the end of this downward leg based on the price action of last week. But it's poised right at the zero line, and it can break in either direction, which we can see already because we're back to the 10-period moving average and the center line of the regression channel. ADX, you can see, crossed over the plus DI here around 14 May, and has been getting increasingly stronger on the bearish selling, and right now it's at 30, which gives it a strong bearish quality. And we're right on the boundary again of sideways volatile. So not a healthy market by any means, but it has resisted the urge to get materially worse, but it's back at the 50-yard line here based on the 10-period. The edge of the Bollinger Band region would be neutral, would be back into normal territory up in here. And so it's got to get above, in my view, above 134, get through this first resistance level to get back into the river, and then it's got to clear 136. If it cannot clear that, then the next target to the downside would be about 128. So still a trader's market by all means. Looking at the ETF2 database, the top 10 regions of the world market model. Every single one of them is on cash, and that puts us at 0% invested, 100% cash, just like last week. SPY is better than EFA, so SPY at 67 is better than EFA at 51. Inside the U.S., it is the NASDAQ, then the large caps, and the mid caps, and the small caps, and that lineup hasn't changed. Two weakest being ILF, Latin America, and EEM, emerging markets, 48 and 49 respectively. So it's just been more of the same in the ETF2. Next up, the world market model. Little change from last week. In the center, the U.S. remains all above average. U.S. real estate is strong. Treasuries and corporate bonds are strong. Weakness in oil, gold, and silver and commodities. Asia less Japan weak. All of Europe is weak. Everything in the Asian countries is poor with the exception of Malaysia. And in the Western Hemisphere, Brazil is horrible, along with Latin America emerging markets, Canada slightly less so, and only Mexico being above average. Inside the business sectors, it's definitely the risk-off trade. So it's conservative positions working right now with consumer staples, that's XLP, utilities, healthcare, and consumer discretionary in the U.S. And you can see the strength in the U.S. relative to their global counterparts. So the U.S. is almost looking better than the rest of the world by default. The top 30 ETFs, it's still the same big four up in here: home construction, biotechs, retail, more regional banks, consumer discretionary, and consumer select staples. XLY and XLP. That's where the strength is right now. I wouldn't look any further than that. That's pretty clear. The NASDAQ has fallen way off, as has XLQ, the tech sector, based on the non-story that was Facebook, I reckon. Inside the Dow 30, using the same techniques. We've had a little bit of rotation among the leaders. You got AT&T. Now listen to these XLP kinds of companies. We've been talking about this for over a month now, and here they are. AT&T, Walt Disney, Home Depot, Walmart, Verizon, Coke, Travelers, American Express, and Pfizer. At the bottom, Cisco, Hewlett-Packard, Caterpillar, Alcoa, United Technologies. Those five are the business sector and tech, basic business and basic industry. It's the consumer spending companies that are working right now. Inside the ETF top 30 for volatility and liquidity, the VIX and the gold miners come in as exceptionally volatile. Excuse me. A quick look at the volatility study. You can see we've had, looking at the last 180 days, the 180 days is a snapshot of the 5-year study. You can see that we hit rock bottom at about 0.4%. Using a 30-day standard deviation. And now it's increased by 50%. Now it looks to be about 0.6 in holding. And that is relatively volatile compared to the last 100 days. And that's why the market classification system has picked up on the relative increase in volatility pretty quickly using ATR percentage. Remember, the market classification uses ATR percentage, which is a 14-day look back. This is a 30-period look back for the standard deviation, but it gives you roughly the same kind of an idea. We're going to shift over now to the daily. Okay, the daily's up. I'm not going to reread the top row. Inside the gap stat, 15 times out of 30, the market has gapped down. 5 of those times it has gapped down and continued to drop for 0.44. 10 times the gap down has reversed, so twice as many times that gap has reversed to close higher, and a positive 0.44. So that favors the morning hook trade if we get a gap down. On the gap up, it has also gapped up 15 times. The gap up that has then reversed to close lower has occurred 11 out of 15 times for a follow-through of minus 0.6. Only 4 times has it continued to gain, and that gained an additional 0.74. So also, the gap up and then reverse is the trade that's paying off. You can see that we have just come out of the oversold condition on the 10-day NDX, no signals in overreaction and channeling. And you can see just how much volatility has been added. It's now well into volatile based on ATR percentage, being up around 1.39%. A ton of signals on the auto framer. Procter & Gamble, United Tech, American Express, U.S. real estate is one that ought to be looked at carefully. I mean, that's been so strong on a sector basis that here's a chance to stock it with a 2-to-1 reward to risk ratio. That's not bad. Along with Microsoft, Cliffs Natural Resources, and the market itself is in a 2-to-1 favorable upside. So there's some possibilities there. You can see the 10-day max pains. JP Morgan, American Express, Intel, Microsoft, DuPont among the ETF 100. That's Russia. The VIX, metals and mining, Australia, and natural gas. Next up is a quick look at the Dow Tactical. Again, quite a large number of dojis in here. Disney, Kraft, Procter & Gamble, Home Depot, 3M, Verizon, and Intel. So there's some good quality companies here. Procter & Gamble's worth looking at. It tests out at a 2.2, and it was a doji, and it's been a pretty darn strong stock among the top 5. So that has a lot going for it. The top 5 max pain range compressions all test out at almost 4-to-1 on the auto framer, so that should be of interest to you too. American Express, DuPont, Microsoft, Intel, JP Morgan. DuPont and American Express, DuPont and Microsoft are also channeling signals, so those ought to get your attention too, Microsoft and DuPont. We'll take a look at those charts after we get through the daily. Next up is the ETF 30. Same discipline, same lenses, lots of dojis, no patterns. However, a ton of them test out better than 2-to-1 on the auto framer, including coal at 9.2-to-1, oil at 5-to-1, Asia less Japan at 6-to-1, the technology at 3.6-to-1. Latin America should be interesting. There's a % winner on Friday, and it tests out at 3-to-1 on the auto framer. So if you get a second day's worth of momentum on ILF, that should be interesting too. So we'll take a look at that chart as well. Next up, we'll look at some of the market mosaics. As soon as that comes up on your screen, you'll see the regression line is still pretty horrible. The R-squared is up around 0.67. That means that that downward slope is a good descriptor of this price action, which we know from ADX as well. Doesn't look good. It's it's below 2 sigma now on the long-term look back, and the percent stretch above the 200 you can see resting right at the 180-day average. So that's not good either. We do a quick commo check here. The audience view is not showing like it's advancing. So let me make sure that you guys are still able to hear me. Mic check. Oh, okay, good. Yeah, for some reason the oh, there we go. Finally, it's starting to change. So just a quick look at a recap on the market mosaics. The regression line slope is horrible. The other ones are looking pretty poor as well. You can also see that reflected in these two new charts. Now, I've just added them this week, so I want to spend a little more time explaining what these are. As you know, on the intraday stuff, I've been using the regression lines to frame my intraday trades, and especially on 1 minute, 3 minute, and 10 minute candles, or 1, 3, and 10 minute time frames. I have been looking at the market, however, on longer term time frames as well, using 30-minute lookbacks as the period of time, and then daily, weekly, and monthly. And what I see is that the 10 and the 30 period regression lines, especially when combined with that Bollinger Band, give some very interesting signals in every time frame. It's a nice way to put a standardized, statistically based, therefore adaptive lens on the market. And it means the same thing in every time frame. Now, what I've done on this one is I've added, I'm looking at daily charts now, so we got 2 of them here. The bottom one is easier to see. That's nothing more than the blue line is the daily closing price in dark blue, and then the channel formed by the green and the red line is a 30-period Bollinger Band plus or minus 1. So when price is inside that channel, we would think of that as the normal range, and when price is outside, then what you've got is trending behavior going in the other direction. Now, what's very interesting about this to me is that when the market makes an intermediate term change and then price begins to trend, when you get a really strong trend, it will stay outside of that 30-period Bollinger Band for a longer period of time than the conventional 20-period Bollinger Band. The 20-period Bollinger Band is much more adaptive, and so you see more price inside of it. However, the 30-period is the one I use because I'm interested in 30 data points for describing normal, for descriptive statistics. And now what you see is, take a look at how about 4 or 5 months ago, this is a 180-day chart, you had price in this noise channel here and then broke out to the upside, and then we had that really brilliant long, almost 3-month run to the top. When it could no longer stay outside of that normal channel, it gets back into the river, Now what you've got is noise. You get price very dangerous inside the Crocodile River in here. And then it broke out to the downside. When it breaks out of that 30-period Bollinger Band, plus or minus 1, what you have is the potential for a new leg down. And that's what we see when price was around 136. And now it had a sharp sell-off. And now this past week, all it's really done is get price back up to, but not quite in, the river. And you see volatility starting to expand. All right, so now, we'll use that as a context for understanding the 10-period, 30-period, and 90-period regression line slopes. So a regression line is the best fit line for a period of time, for a set of data over a period of time, using the least squares method of computing. So when price is going up, that regression line starts getting steeper and steeper until price can no longer go up anymore and then starts to roll over. And what would happen is that regression line would also start to roll over, much as you see those Bollinger Bands rolling over. And so then what you have is the slope starts to degrade. Now that's sort of normal. What we have now on the top chart here are the slopes of 3 regression lines, but because they are of different time frames, you'll see that the slope of the 10-period moving average changes quite a bit, and so I've shown that here on the blue line. You can see it gets from really great to really bad to really great, and so it oscillates a lot. The black line is kind of a smoothed version of that. That's the 30-period regression line slope, and then the red line is the 90-period regression line slope. Now, if I use just the absolute values of the slopes, it wouldn't look like the slower regression line slopes changed all that much at all. Because they're slower, they rarely get incredibly steep, and they would look almost flat, very hard to see. So what I've done is I've gone back 10 years and computed the 10, 30, and 90-day regression line slopes for all of those days, and then found the average, the maximum, the minimum, the standard deviation, and then created the z-score for each one of those, and then normalized them basically using the standard deviation. So now we can actually see, based on a historical 10-year reference frame, just how steep in one direction or the other the regression line is. And I've shaded the areas of +1 to -1 standard deviation and just treated that as something, let's just call that the historical normal range for the slopes. So now what you see is at this current level, you actually have the 90-period regression line slope getting better. It was at -1 for a long time, and then is now getting better. And what we see now is the 10-period regression line slope hit the -1 standard deviation, has now started to improve, and it's almost back up to the average. And that's based on the power of these last 5 or 6 days of buying pressure. That's not a bad 5 or 6 day move. But the 30-period regression line isn't convinced. It actually broke below its -1, and at no time in the last 180 days has that been less than -1 on the z-score. So that's actually very bearish. And you can see that now this is also 180 days of look back, so you can read straight down from these moments of extreme and see what price was doing at that time. For instance, about 5 months ago, the 30-period regression line hit its 6-month peak at +2 standard deviation. If you look down, it's basically this period in here, very, very positive, and it couldn't hold that, and then it got horrible. By the time it broke through the Bollinger Bands and got down here, it bottomed out and then started to get better. Now what I want you to notice is at -1 standard deviation, the 10-period was also down around -1. They were both here and then both started to get much better, and the 30-period got really strong, and that coincided with this strong bullish move in price. And then right around here, it couldn't get any stronger, and then slowly started to grade until right about here when price was back in the price region inside the river, and then it really voted bad and has gotten steadily worse ever since then. So the 30-period slope of the regression line is a pretty darn good indicator when it makes a turning movement outside of the plus or minus 1 z-score. That's something that should be very carefully attended to. Now, there was only 2 other times in the last 180 days that both the 10 and the 30 were down here around -1. In both of those cases, price got better, and you had really strong bull moves that followed. You had 1, and then you had 2. But what's happened right here is that the 10-day has turned, but the 30 has not yet. And so what that suggests is this may be materially different, that if it doesn't get back into that river, if it does not get back above 135, which is where the resistance levels are, then this blue line is going to roll over and get bad again. Now what you'll notice is that you have a series of decreasing highs in terms of z-scores. You had one up around here plus. You had 1.5, then it increased to 2, but then it only got to 1, and then to only about 0.75, and now it's still below 0. So if it rolls over here, what you would have is 3 declining highs, and then the blue and the black would both be going low, and then this could open up for a really bearish move. So we're aware of that. That would a move that fails right here at about 133 or 134 would feature a return to sideways volatile and then quickly get into bear volatile, and then we would already know. But we can already see that that's happening here because we've already had just one leg down when price broke down out of the river, and now it's being rejected at the edge of the river. So if it rolls over here, in other words, if it does not get above 135, 136, then it will not get back into the river, and we could have another nice long bearish move down, being rejected by the lower Bollinger Band there. So what this is part of this is a new really indicator, I guess, new lens to look at using the z-scores of these 3 regression lines, using the 10 in blue, the 30 in black, and the 90 in red. And the text over here explains sort of the math logic behind that. I find that this regression line relationships between the slow and the fast to be very powerful intraday. It's helping me get a standardized look at longer term time frames as well. I like the way the Bollinger Bands, the 30 period plus or minus 1, gives us important information. This is a different way of using Bollinger Bands than you will find in general. What I'd like you to notice too is just how narrow the river got here in this sideways quiet channel. I have another chart where I'm measuring the relative width of that Bollinger Band. And so this is actually a breakout from a sideways quiet channel to the downside, and then based on this powerful sign in the 30 period regression line, I have a decidedly bearish tilt to my psychology right now. So I find this to be a very, very useful chart. Okay, moving on. This one is the I want to talk about. This actually measures. I haven't filled in all the text for you yet, but this one measures the Bollinger Band channel, the width percentage. So this measure, if you think back to the previous chart, this one measures the width between the red line and the green line, and you can see that there was a period of sideways quiet channel, and now that river is getting wider. And right now it's 5% from the red line to the green line. You might want to know that because that's a reasonable trade, that if you're planning the reversion to the mean trade and then you think it might overshoot that a little bit further, like right now if I was playing the long side, I would use the green line, the upper Bollinger Band, as a price target. Now I know that it's 5% across that channel. That's $8. Now if you normalize that, and just look at it on a standard deviation basis, this is what you have. The Bollinger Band right now is about at average width compared to on a percentage basis compared to the last 10 years. So kind of a normal width in the band. But you can see it's come out of this quiet channel and now starting to get volatile. So that tracks the volatility statistics pretty well also. So I find these two new charts, I just added them this week, although I've been looking at them for a while privately. I really like the idea. Mike asked me, is the z-score formula slope minus average divided by standard deviation? Yes. If you let me go back one. I'm going to go back one slide. Yeah, if you take a look on in that gray text box to the side, z-score noted down in here. Okay. I will probably look for a way to combine these two charts into one. I maybe just make them a little bit smaller so I can get all three. I think I only really need the Bollinger Band width, because I think it would be nice to have that Bollinger Band width frame in here so we could, because what we're actually doing is measuring what is the percentage, as a percentage of price, how wide is that channel right in here. If there was some way in Excel I could figure out how to shade that in, I would. But that's what we're measuring on the next chart. Daryl asked me, is the BB channel width 2 standard deviations or the max? No, the width of the channel that's shown on the chart right there is plus or minus 1 standard deviation. So it's actually 2 standard deviations across, because it goes from average minus 1 to average plus 1. So it's actually 2 standard deviations across there. Most of in the conventional use of the Bollinger Band, they only look at a 20 period moving or 20 period look back, and then they use plus or minus 2. But for my purposes, it's more consistent with the way that I look at the market to use a full 30 period look back, so that we're authorized to use descriptive statistics, and then only plus or minus 1 to define the range of normal. So yeah, slope minus average divided by SD gives you the z-score. Correct, Mike. Okay, moving on. I'm not going to cover the other the reference data. I just want to get to a few charts. I spent a little bit longer on that than I had planned, so let me call up I want to look at just a few. Well, wanted to look at Microsoft. Okay, here's a quick look at Microsoft, and I've labeled this this little setup here, my tactical setup. This is now my default setting, and so just a quick look at what I look at on the dailies, right? So at the top I've got the ADX 14. So when I read Microsoft, It's in a bearish strong trend here because the ADX line itself is at 27 and rising, and the minus DI is better than the plus DI. So what you have here is a a strong downward trend. Well, we know that from the fact that the price has crossed the river. It got up here into the river, rejected, came out of the river, tried to make it back to the mean. That's all it could, and then failed out of the river quickly again. So what you have is that that downward price action here. You see almost in ADX terms, the jaws of the dragon opening up. It's been oversold most of the time. PPO crossed over right here. Same place at the ADX crossed over, and it failed out of the river. Man, when you start putting all those things together, that becomes really important on an intermediate time frame. Look how those indicators kind of line up. ADX crossover here, rejected on its attempt to get out of the river, came down to the river, failed out of the river, was oversold. The PPO closed here, started going down. I don't know why that is. I'm going to come with a better. Yeah, that's a better. Yeah. And now it rejected at the Bollinger Band mean and has been down ever since, and that corresponds with the PPO pointing downwards. I like the fact that, well, I don't like it, but I notice the fact that the price outside of the river is an important indication of primary trend direction. Now we've had 3 days of it failed to fail further. So now if we can actually get some upward movement, the price target would be here at the mean of the Bollinger Band, followed by the far side of the Bollinger Band. I think if you waited till price got into the river and set a target on the far side of the river with the swing low being here, you still have 2 to 1. You would have 2 to 1 upside, drawn by this. There's your 2 units of reward. Here's your 1 unit of risk. And that's why Microsoft tests out pretty well on the auto framer. If you go back 10 days, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, you actually get a price right around in here. So it tests out really well on the auto framer. This would be a natural place for it to find support. All right. All right. So next one up, we wanted to look at it was DuPont as well. DuPont's in even better shape. Man, I just love this setup as a bottom feeder. You can see that there was this strong sideways quiet channel in the blue box. Very narrow river width here. So notice how sideways quiet channel, and the 30-period moving average slope is basically flat. When you have a flat slope and a very tight little box, that's sideways quiet channel, then it breaks out of the river, makes that sharp downward move, almost 7 or 8% from the river. And now what you had like 5 horrible selling days in a row, and now you got this nice little support level here. Now if you get a price above 49 and then with a risk at about 48, so with a $1 risk, you can see that going from 48, or really from 49 to 51, that's a $2 move. So you got +1, +1, +1, +1. You really have 4 units of reward to 1 unit of risk. And then all you have, and then you can wait until price breaks above. You could wait till you see price breaking above 49.5, and you're still going to have 2 to 1, and that's on DuPont. Now, it would take a strong move to do that, certainly, but you have a nice strong base of support. A lot of people buying it. Now you can see the PPO has moved up. We've come out of the oversold condition, so DuPont has an awful lot going for it. Let's see if my old buddy Alcoa, which is in kind of the same sector, let's see if Alcoa offers the same kind of insight. And my bet is that it will. Birds of a feather. And that's even better. I think you can see, or at least it seems to me to be better, because the sell-off was not as harsh. You know, although you can see how it has rolled over. The river is sloping down. The 50 is sloping down. Price broke out of the river here. It broke below this key 9.4, sold off to 8.4. That's an 11% move. And now it's had 7 days of sideways consolidation. Now if you can get a price above 8.8 with a stop at about 8.4, that's 0.40 cents. And you go, here's 1 unit of reward, 2 units of reward, 3 units of reward. So you got a 3 to 1 reward to risk ratio just on a retest of these various parts of the river. You see how the river is getting wider. That's just an increase in volatility, meaning that people were panic selling. But it's no longer oversold. The PPO has crossed over. The PPO histogram is moving up. That looks like that's a very nice little swing trade setting up, in my view, for my old pal Alcoa. The last one I want to look at is U.S. real estate. We talked about that one during the briefing. IYR. Oh, that's pretty nice too. It's been like the strongest sector based on moves like this. The last time it broke down here, harsh sell-off, found support. I mean, look at the strong support here at 59.60. It's been consistent. So it's had one little move up here. A breakout above 62 can get to 64. You'd have to have about a stop around 61 to believe in that move. But then if it gets through 64, it gets to 65, and then if it gets above 65, it's gone. So there's some potential in IYR. So I'm hoping that you can see how this the use of this Bollinger Band helps give some insights into some of these swing trade type time frames. Gives you a very nice visual about what normal is, what the direction of normal is. What I like about IYR is that the river is still pointing up. It has just now gotten sideways, so there's still a lot of strength. In the previous ones we looked at, you could see that the slope of the river had already rolled over and gone south. So here's one that's among the strongest. Just as a point of comparison, now that I'm thinking about it, let's look at IBB. That's at IBB is the biotech, if I remember. Yeah. So except for this weird anomaly in here, that big long weird tail, I mean that never even broke out of the river except for this one strange day. So it's going up strong and ready to break out of the river again. If it gets above 127, there's nothing holding it back. Let's look at XLP, because I've been blowing the horn on XLP for a couple of weeks now. XLP is in good shape too on a relative basis. I mean, the river is still pointing up. If you follow this, the middle of the river right here, it's back in the river already. It only had this one little drop out of the river, and it's held strong support around 33.4. And if it gets above 34.4, off it goes. XLY was another one we saw that was high on the list in ETF2. Let's see what that one looks like. I think XLY offers a little more tactical room to go. It's not as more volatile than XLP, but then this is consumer discretionary. If you hypothesize 42 as the low. It's already made it back to the edge of the river. A breakout above 43.5 with a target at 45.5 with a dollar stop at 42.5. There is your 1 unit of risk. And then there's your 2 units of reward. And that's and then with resistance expected at 46. Now if it gives above 46, that thing will really go well. But you can see how this is it wouldn't surprise you if it resisted at 45.5. So you should not, if you try this one and it works, it starts hesitating at 45.5. It's supposed to. You would then have a perfect head and shoulders, and then it would fail further. So if you try this trade and it gets to 45.5 and then starts rolling over, don't stick around. Cash that profit. But this is one that's one of the 2 strongest sector spiders, and the U.S. has the juice, and these are all large caps. So the U.S. is the strongest region. The large caps are the strongest based on market cap, and then XLY and XLP are the 2 strongest out of the 9 sector spiders. I mean, if you can't trade those under those conditions after a pullback, then you can't really trade intermediate term frames anyway. This is a perfect setup with a clear 2-to-1 to the upside, and so hopefully you have a chance to see how the river, this 30-period Bollinger Band, can help you frame your ideas, especially when you supplement it with some things like the overbought, oversold oscillator and this longer-term percent price oscillator as well. But I really like the looks of this XLP XLY. So it's 8 o'clock. That's everything I wanted to say. I hope you guys have a great Memorial Day weekend. Go shake a soldier's hand tomorrow. And just give them a little quiet thanks. Just acknowledge them. That's all they need. You really don't know how far that goes. So I had tears in my eyes today at Sporting KC Stadium. The gal who sang the national anthem just knocked it right out of the park. Had a beautiful, powerful voice, and she just sang the song without any histrionics or fireworks. But man, she just sang it from the heart and made an old fat guy get a little misty. And it was a really nice tribute to a soldier's family that was there receiving some honors and recognition from the crowd. And it was just a really good day to be with family this weekend. So make sure you get a chance to do that. Tell them you love them. And keep your powder dry and your risk managed. That's all I got here. And we'll see you in the chat room. I think the market's closed tomorrow. So we'll see you in the chat room on Tuesday. I would also like to ask you to think about your favorite questions to ask me. I'm going to put out a note later tonight. I'm going to do a special webinar and another ebook, I think, that basically just answering questions from the field. I want to turn that into a growing another ebook on the trading questions. I'm feeling the literary juices flowing here, and I'd like to get another one out. So I'll send everybody a note with to solicit questions you'd like me to address in an ebook and with a video accompaniment of it. And so look for that, and we'll get on with it. So have a good weekend. You guys take good care.